So, good afternoon, everyone. Is my screen visible? Thank you for joining us this Saturday. So, today we are going to look at India's port and logistics sector. So, I'll just get right on with it. So, ports are a direct proxy on India's GDP growth. 95% of the trade volumes in India are handled by the ports. The main cargoes handled by the ports can be classified into containers, dry bulk, liquid and gas cargoes. So container cargoes is a proxy on merchandise trade, where India's share in the world is just 2% compared to 14% for China. The bulk cargo like coal, iron ore, and steel are proxy to the industrial growth. Liquid cargo like LNG is a direct proxy. LNG and LPG is a direct proxy on energy consumption. Second, there are a lot of government policy tailwinds for the sector, which we'll discuss in the upcoming slides. Thirdly, this is an industry with high entry barriers. It operates under the PPP model or the public-private partnership model, where the operator doesn't necessarily own the port. He works in a partnership with the government. So they competitively bid and sign contracts with the government to run the port for a long-term period, let's say 25 to 35 years, which also gives them stability of cash flows. So only corporate conglomerates can do this business at a scale. Building a port infrastructure, it involves significant capex for dredging, building berths, terminals, equipment, storage, and other facilities. So it approximately costs around 2,000 to 5,000 crores of capex per million tons. The lower end, the 2,000 crores is might be for a brownfield expansion, whereas the higher end, the 5,000 crores per million ton capex could be for a greenfield non-major container port. So it varies based on your dredging requirement, the evacuation system which is already in place, and various other factors. The optimal location for a port with respect to a demand-centric hinterland and allied infrastructure connecting the port to the demand centers also serve as entry barriers, since there are only select such locations. And also the port developers, they encounter significant regulatory requirements for securing land or berth from the government, concession agreements, permission for handling different types of cargoes, and also environmental clearances. So obtaining permissions and acquiring land are very cumbersome and time consuming. Therefore, they also serve as entry barriers. So delays owing to these factors may also lead to significant capital cost escalation. So due to these entry barriers, port operators face relatively low competitive intensity and high capital requirement. So, but they do have stability in cash flows. Uh, the EBITDA margins for the India's two largest port operators range between 55 to 60%. Almost 100% of their PAT or their profit after taxes is converted to cash flow. So, due to the long-term nature of the port concessions and the relatively long-term cash flow stability, ports are typically preferred by equity or debt investors with long-term investment horizons. Let's move on to the next slide. So, this is the logistics sector growth over the past between FY12 and FY22. Logistics is a crucial auxiliary service for all economic activities, and hence there is a significant policy thrust on increasing efficiency in logistics services to reduce the overall cost of doing business and be competitive with the other exporting countries. Therefore, logistic cost as a proportion of India's GDP has declined from FY12, where it was around 9.4% of GDP, to now, where it is around 8.4%, which also reflects on improved logistics competitiveness. So this is the split up of the logistics industry. The Indian logistic ecosystem, it comprises of transport infrastructure, which includes shippers, road carriers, railways, and airlines. Supporting infrastructure, which includes ports, infrastructure, cargo terminals, and warehousing, and other third-party and fourth-party logistic services. With the advent of e-commerce, these third-party and fourth-party logistic service providers have witnessed explosive growth, though profitability concerns are yet to be addressed in this space. India's share of cargo volume. India has one of the biggest coastlines in the world. We are covered by coast on all three sides of our country, and spans up to 7,500 kilometer. Uh, because of this, we have seen a substantial expansion in port capacity and volume. Currently, the country has around 12 major ports and around 65 non-major ports. We'll discuss what is a major and non-major ports in the upcoming slide. The maritime sector, it accounted for 95% of India's overall trade by volume, sorry, and 70% by value. So why this differential between overall trade by volume and value is because the higher value critical products are usually transported by air freight. So based on the data from the Ministry of Shipping, Indian cargo grew at a rate of 4.7% uh, during FY 14 and 24. So during this period, India's share of global seaborne volume, trade by volume, expanded from 9.7% of GDP to 13.3% in FY24. The rise in India's share reflects India's higher than peers GDP growth as well as significant rise in export import volume. Here, roads still account for about 66% of the inland logistics transfer, while rail accounts for about 31%, and coastal shipping around 3%. We'll discuss that further in the next slide. So we see here, uh, Indian, as we saw in the previous slide, India's inland logistics system is dominated by roads, which has 66% model share, as compared to railways, which only has a 30% share. A small but growing share is also taking place via the coastal shipments, uh, wherever feasible. So coastal shipments is essentially, let's say you transport coal or iron ore from a port nearby a mine to supply to a steel mill or a power plant which is nearby another port. So when a shipment happens inside the country itself, it's called coastal shipments. For example, JSW infrastructure, it supplies coal from its Krishnapatnam port to its coal bulk terminal in Thoothukudi for the NTPL power plant. So the government is providing policy support for increased modal share of rail as well as coastal shipping because of the decreased cost when the distance increases. So while rail has cost advantages over roads in longer leads, heavy congestion leads to unplanned delays and uncertainty in container delivery timelines. So this congestion is due to an underinvestment in railways over the past 5-10 years. Uh, we know that over FY 10 to 24, the national highway network has expanded by 2x, while the rail network has only grown by 19%. So this underinvestment is in railways compared to roads is leading to this inefficiency and higher share of roadways in the model mix. So government is focusing more has more policy thrust to increase the share of railways in our current hinterland logistics transport. Let's move on to the next slide. So there are two types of ports as we discussed in the previous slide. One is major and the other is non-major. So the major ports examples are the Paradeep port, the JNPT port in Mumbai, the Kandla port, the Chennai port, etc. The non-major ports include Mundra, which is operated by Adani Ports, and Jaigarh and Krishnapatnam, which are both operated by JSW Infrastructure. So these are some of the major ports in our country. So they operate under the private-public partnership and are mainly managed by the central government. The port authority here acts as a regulatory body and the landlord. They have so the private companies they bid out for tenders in these terminals, and hence a private-public partnership is established. So the terminals in these major ports they share the evacuation infrastructure. So there is high congestion levels in these major ports, especially in JNPT in Mumbai and all. So there are also limited expansion possibilities. So if we see the cargo traffic at major ports, it has grown at a CAGR of 3 to 6% over the past 5 years, and is also expected to retain the same growth rate going forward. So these are some of the major ports in our country. The Kolkata port, the Paradeep port, the Chennai port, Tuticorin port. These are ports in the east coast and the ports in the west coast. And now the non-major ports, the cargo traffic here has grown at the same 3 to 6% over the past decade and is expected to retain the same growth rate. These non-major ports are essentially managed by the central government, and they usually cater to the regional industries and specialized cargo. For example, Mundra port it caters to the industrial cluster in the northern hinterland, like the tiles cluster in Morbi. Plus, they also have a high capital requirement since they have to do all the dredging work, the terminal work, they have to order the equipments themselves and also build out the evacuation infrastructure themselves. So, and because of this, they also have a long gestation period to stabilize. So, a ramping up of a major port will happen relatively fast in 1 or 2 years because they already have an existing infrastructure and existing clientele base. But for a major port, it will take between 3 to 4 years to reach optimal utilization levels. So if you look at the capacity utilization of ports, overall Indian port capacity utilization is around 55%. Sorry, which is expected to be the same in FY 28 as well. So the overall Indian port capacity at 57% might look optically low and may give the impression that there is adequate unutilized capacity. However, we note that there are wide regional disparities in utilization levels. As an example, let's say leading states like Gujarat, they have a capacity utilization of 67% and a high volume growth rate as well. Thus, there is a need for capacity expansion in this region. And plus, the port capacity it takes long time to set up. Let's say it takes between 2 to 3 years. So, because of this reason, the supply of capacity always is ahead of the demand growth. So, perpetually, it will run at around 70 to 75% capacity utilization. Further, the nameplate capacity also might be impacted because of evacuation bottlenecks due to weak inland logistic infrastructure. Thus, to boost capacity utilization, investments in inland logistics are required as well. We know that the debottlenecking projects like the Western and Eastern direct freight corridor are also already taking place. A significant amount of industrial capacity coming up near the ports. For example, there are a lot of cement plants and steel mills which are being, and also power plants which are being set set up nearby the port infrastructure. So these kind of coastal industrial capacity, they will reduce the dependence on inland logistics. So these factors should support strong volume growth in the medium to long term. So deferred port capacities, there are a lot of capacities were deferred during the COVID pandemic. We can expect them to come online over the next few years. India has a plan to add 500 million tons of capacity over the next 5 years. Major ports will be contributing 65 to 70% of this new capacity. Let's talk about the cargo handled in our ports. So the cargo handled in our ports depends on where the port is located. If we look at industrial clusters where there are a lot of iron ore mining or steel mills, it tends to be dominated by iron ore exports or steel ingot exports, iron ingot exports. And the clusters which have electronics manufacturing or defense manufacturing or merchandise exports, they tend to be dominated by container traffic. And the other discrete manufacturing or coal power production, they tend to be dominated by bulk terminals. So the traffic and the coal traffic uh, directly results in what kind of infrastructure the ports have to build. A container terminal and a dry bulk terminal, it has different infrastructure and different operating metrics. So these are some of the policy support the government is giving for the sector. The Sagar Mala, the Maritime Amritkal vision, which we'll talk in the next slide. More privatization of ports. So the public ports which are being run by the government, they are largely inefficient. So the government is looking to privatize these ports. So currently about 55% of ports have been privatized. This share is expected to grow to 85% in the next 5 to 6 years. So a lot of port capacities will come for privatization, which can be a good growth lever for private port operators like Adani and JSW, and also the direct freight corridor. So, despite India, we have had a world-class port infrastructure historically, but they have lagged international peers because of the policy inefficiencies and also the weak inland connectivity and slow bureaucratic processes. However, the government's recent thrust on these kind of policies can alleviate these constraints. So, this is the Maritime India vision. So, they want to take at least three major ports to 300 plus million tons per annum capacity. They want to increase the percentage of cargo transshipped by Indian ports from the current 25% to 75%. So transshipment essentially means when the draft length of your port is less, large cape-size vessels can't dock into your ports. So what you do is you send smaller ships to these transshipment ports from where the cargo will be loaded onto a bigger cape-sized vessel and will be transported to long distances. So currently only 25% of our transshipment is handled by Indian ports and the rest is handled by ports like Dubai's Jebel Ali, um, Colombo's port, etc. And also, they want to increase the ports with more than 18 plus meter draft availability from 5 to 9. So, draft availability was what we discussed earlier. As your draft availability increases, so 18 plus meters means you can accommodate like bigger and longer vessels. And they also want to decrease the average vessel turnaround time, which is 25 hours currently, to less than 20 hours. So vessel turnaround time is how much ship spends coming into the port, unloading and leaving the port. So they want to decrease this by around 5 hours. And average container dwell time, how much time a container stays in the ports yards before being evacuated by the let's say rail or trucks. That is a container dwell time. So they want to decrease it by 15 hours from 55 to 40. And they have a target of being the number two in terms of productivity in the world by FY30. So these are the various business models of the port sector. There are four types of model: the landlord, the service, the private service, and the tool port model. Service model, we see the port authority owns the land and all the available assets. It also provides all the regulatory functions of the port and employs all the labor for cargo handling at the port. If we look at the tool port model, this model divides operational responsibilities between port authorities and the private operators. The port authority owns, develops, and maintains the port infrastructure and superstructure. So these equipments are usually operated by the labor employed directly by the authority. So the private person just provides the equipment. So the land port model, this is characterized by the mixed PPE. Under this model, the port authority acts as a regulatory body and as a landlord, while the port operations are carried out by the private companies. The landlord port model is the dominant port model in larger and medium sized port. And then there's a private service port. In this model, central or state government does not have any direct involvement in the port activities. Port land is owned by the private sector, and all the regulatory functions and operational activities are performed by the private companies. The landlord and the private service port models are the more relevant port models with the companies which we are going to discuss about. And there are a lot of mega trends which are emerging in the Indian port sector. So, mega trend number one is a preference for integrated logistic solution. So I had various interactions with the port logistics stakeholders, and they suggest that the customers are increasingly opting for players providing end-to-end logistic solution. So this has led to port companies integrating backwards into rail, which can be both container and bulk, to ICDs or inland container depots, to warehouses, to first mile and last mile logistics. So this partly explained the increased thrust for backward integration by traditional port companies like Adani Ports and JSW Infrastructure, and also even DP World. The second major mega trend is the emission reduction across the entire supply chain. Customers are focusing on reducing carbon emissions across the supply chain. So international companies, because of let's say carbon border adjusted mechanisms or CBAM in Europe, they are focusing more on emission reduction as a part of their global mandates. And we expect the trend to strengthen. This trend is also driving port operators to invest in improving the energy efficiency, increasing electrification by using more green power, and also favoring rail transport to roads. So as we saw in the Maritime Amritkal Vision, they want to increase the share of green power from 10% to 60% by the end of 2030. So this is another mega trend. The third mega trend is the continued privatization of major port terminals we discussed earlier. Uh, the increased thrust on terminal privatization of major ports is a huge mega trend which is happening. At present, um, more than 50% of the major port cargo volume is handled by the private terminals. Since the past 5 years, this number has significantly increased. Before 5 years, it only used to be 25-30%. As a result of this, there has been significant operational gains. The government intends to further privatize terminals to boost productivity. For context, of the privatized ports, just 34% of the ports have been privatized so far. But as a share of volume, it accounts for 50%. So this discrepancy is because of the higher volume, higher efficiency in private ports, which has led to volume shifting towards them. So this is a revenue model of the port. So it mainly derives revenue from three areas. One is the navigation charges, the berth and wharfage charges, and the cargo operations. So when a ship calls, the port provides navigation assistance to the vessel for berthing it at an appropriate location at the port via tugboats. For this, the port operator levies this navigation or marine charges, which includes pilotage, tug services, and port dues. These usually are based on the size or the tonnage of the ship. The port operator also levies charges for the use of the berth at the port, which is the berthing and the wharfage charges, and also for the loading and unloading of cargo from the ship and other ancillary services. These are usually based on the volume of cargo unloaded or loaded by the ship. And thirdly, the cargo operations include a variety of charges for handling cargo, including loading, unloading, custom processes, storage, and other ancillary services on the port premises. These are usually based on the volume or the complexity, in some cases, even the complexity of the cargo. For example, liquid cargo, which requires specific handling and storage facilities, they can have more higher cargo operation charges. And also, not all ports are capable of handling such hazardous cargo. And if we look at this above diagram, so this is a cost structure of a particular port in JSW Infrastructure's portfolio, the Jaigarh port. So the royalty paid to the government and the cargo handling expense and the repair and maintenance form the majority of the charges. Most ports in India have either leased berths or terminals of government operated ports or secured land from government on a long term lease basis to construct the port infrastructure. Hence the high cost of royalty. So the cost of royalty also depends on how aggressively you bid for terminals. If you bid more aggressively, your royalty cost will tend to be higher. Ports and the cargo handling expense, which is 42%, is also a high contributor. So ports which have a higher level of mechanization or lower operating expenses are far more efficient than labor-intensive ports. However, higher level of mechanization also would mean higher investments or capex. So the OpEx or the versus the CapEx trade-off is largely would be a function of port volume and how the port envisages the volume would scale up in the future. And power and fuel also cost 12% of the overall cost. So this cost is largely linked to crude today, which the port authorities are, with the transition to renewables, are looking to reduce this cost. Let's talk about the first company, which is Adani Ports and Special Economic Zones. So this company is India's largest port operator. It has largest private port operator. So it has multi-cargo and multi-asset portfolio. So it handles containers, it handles liquids, it handles coal and other dry bulk materials. It is also an integrated logistics play. So they have a huge ecosystem, which I'll discuss later on. So it is an integrated logistics play. It is also a play on the Western DFC. So the Gujarat's Mundra port has already been connected to the Western DFC, and the Western DFC is largely complete. Only the last part, which connects to the JNPT port, is yet to be done. Once this is done, it will lead to lower railway congestions. For more information on DFC, my colleague has already done a webinar on the direct freight corridor. I suggest you to view that. Because Adani Ports is also a global play. They have ports outside of India as well. They have a transshipment port in Colombo. They have a port in the Middle East and Australia as well. So if you look at the picture here, so Adani Enterprise is present in the value chain from end to end. So this is a play on one of the major themes which are one of the mega trends which is happening in the logistics sector, which where the customer requires end-to-end logistics services. So Adani Ports, it aspires to be the largest integrated logistics solution provider in India. Towards this end, its subsidiary Adani Logistics has ambitious plans to increase rail rake capacity, um, especially in container trains, along with the investments in ICDs and MMLPs, which are multimodal logistic parks. So these investments, so it has around 12, it operates 12 multimodal logistic parks today, which it aspires to get it up to 20. So we can, this is already reflected in sharp market share gains for Adani Ports at the expense of leaders like Container Corporation of India. And this market share gain can be expected to sustain and even accelerate as Adani Logistics has planned to, increase railway rakes further. It has also invested in its own truck fleet. So currently it operates around 900 trucks to provide reliable first mile and last mile services. And also they intend to take it up to 5,000 trucks. Additionally, they also have plans here, if you see, to develop significant warehousing space. So currently, the warehouse capacity is at 3.1 million square feet, which they intend to take it up to 20 million square feet. So these warehouses are ROE accretive. They are potentially 40% plus return on equity. And such assets also could be eligible for priority sector lending since government is focused on increasing the warehousing footprint in the country. Warehouses also give a steady rental income. So around the income is around 250 to 300 rupees per square feet, and the EBITDA margins are also pretty healthy at 70 to 80%. So these are the expansion plans that Adani has in its logistic division. So this helps the end customer because his paperwork and his cumbersomeness is reduced. So if you go to Adani, he will handle the from the first mile logistics to the custom clearance at the MMLPs to the warehousing to the first mile, last mile transport by the trucks, and to the shipping of containers to the foreign export countries. So the headache of the private manufacturer is reduced in this regard. This is Adani's market share gains over the past 10 years. So in FY17, its market share was around 15%, which has grown up to around 27% today. But if we look at its capacity share, it is around 18% only. So while the capacity share is 18%, but the volume share is 27%, it goes to show how the customers are preferring Adani ports for handling their logistic needs. Yeah. And also, typically, they establish greenfield ports or acquired ports located near key demand hinterlands, where the government has already invested in evacuation infrastructure. Due to the existing evacuation infrastructure and port operations that are comparatively more efficient than peers, especially major ports, the company has been able to take market share from the incumbents in the region. So, for example, Adani Port's Mundra Port, it competes with the Kandla and Gujarat Pipavav Port, uh, and also with JNPT Port. Adani has witnessed market share gains in all of these individual clusters. So these are the growth in volumes of Adani infrastructure. So if we look at FY17, its volume has grown from about 180 million tons to 251 million tons in FY21, rising further to 457 million tons of cargo handled in FY25. This growth in volume is evenly split between organic, which is accounting for 143 million tons of the 270 million tons volume growth, and 99 million tons from acquisitions, which are mainly focused on the East Coast and the ports in Israel. And it has also uh, increased 18 million tons of volume from the turnaround of the acquired assets. Um so yeah, so these are the efficiencies of ROEs of the ports in Adani's portfolio. We see Adani Ports has come a long way from being just a Gujarat-based single asset, this is a Mundra port, to having significant presence along the India's west coast. In the past, Adani has demonstrated a strong record of acquiring assets at reasonable valuations and then turning them around. Among the bigger ports, Adani acquired Dhamra from the Tata Group of companies, and Kartupalli port it was acquired from not wrong L&T. These assets were loss making, and if you see their ROE metric also, it was like pretty low. So since the acquisition, we have seen significant capacity expansion, efficiency gain, and volume market share gains. And because of that, the ROE has expanded significantly in these acquired assets. If you look at Kartipalli, it has expanded from 3% to 9% today. If you look at Krishnapatnam, it has expanded from 8% to 15%. Dhamra, it has expanded from 11% to 22%. So similar trend can be expected for its more recent acquisitions at Karaikal and Gopalpur. So this slide it depicts the percentage of sticky cargo. The first figure depicts the percentage of sticky cargo in Adani's portfolio. So typically, dry bulk or liquid terminals, they have a long-term offtake, and the cargoes are sticky. So if we look at the share, it is around 55% of cargo is sticky in nature. If we look at the slide, the next picture, you can see they also handle diverse cargoes, which adds an element of resilience to the port cargo volume. So we'll discuss some risks associated with the Adani ports and infrastructure. So one could be its deterioration of group financials and resulting need for related party loans or rising share pledge, which could lead to a derating. So these related party loans and rising share pledge has happened a lot in the past, but it has become lower now, and it could be a thing of the past. And any weakening of the domestic macroeconomic environment could lead to weaker port volume delivery and result in lower than estimated ROE levels. The recent slowdown in thermal coal imports and iron ore exports are an example of this. Third is over leveraging. A sharp spike in capex levels could result in net debt to EBITDA exceeding the 3.5 mark, which can lead to over leveraging concerns for the stock. Plus, they have also Adani has raised a lot of money from bonds which have covenants. So, in case of over leveraging, these covenants can be triggered, and interest rates could rise. But however, this scenario appears less likely in the near to medium term. Also, prolonged aggressive pricing in the logistics segment could drag down the margins and lead to an overhang in the group ROE. For context, the margins in the logistics business is just around 15 to 20%, while the margins for the ports business is 55 to 60%. So the logistics, although it is an important lever for them, it is not very ROE accretive in that regard. They want to focus more on logistics to capture more market share and sticky customers. So yeah, and also the international expansion could be a risky proposition given the geopolitical risks. For example, in the current Israel-Hamas conflict, and also the conflict in the Red Sea from the Houthi rebels, volume growth in Adani's Israel assets could be impacted. The proposed Indian Middle East corridor project also might get delayed, and as a result, impact the long-term prospects of Adani Group projects in Colombo in this corridor. So the Colombo, the Villingen transshipment port, and the Israel's Haifa port all fall in this IMEC corridor. These are some of the risks associated with the company. Next, looking at JSW infrastructure. So it is the second largest port operator. It has a lot of group captive cargo, so it can so group or captive cargo is generally stable and is linked to its steel capacity expansion at JSW Steel. So it is a proxy to steel demand as well without the pricing risk of steel. It is also a proxy to coastal coal and liquids growth. And recently, they are trying to mimic Adani Logistics by foraying into logistics themselves. So in that regard, they had acquired a company called Navkar Corporation last year, and they have a lot of plans to scale their logistics arm, as we'll discuss in the upcoming slides. So JSW Infrastructure is also play on JSW Steel's capacity expansion. So JSW Steel has a plan to increase the capacity to 51 million tons by FY31. Um, so the raw material logistics and the coastal coal movements will be handled by JSW's ports in Paradeep or the ports in Ennore and Tuticorin. And because they have this group captive cargo, their ramp up of their capacity is generally faster because you have a strong offtake partner. So let's say if major port utilization ramp up takes around 3 to 4 years to reach optimal utilization. JSW can ramp it up faster. So this is JSW's plan from the presentation. The management, they have targeted a capex plan of around 39,000 crores, of which 30,000 crores will be targeted to the port capacity expansion, and the remaining 9,000 crores of the 39,000 crores is for expanding their logistics arm. Currently, the port capacity at the end of FY25, that is, the port capacity stands at around 177 million ton, and the traffic handled in FY25 was around 116 million ton. So this capacity can potentially exceed 290 million tons by FY28. With the capacity expansion, it has planned at JNPT, at Goa, and at Tuticorin terminal. The management, they have provided a near full visibility of around 362 million tons, which it envisages to achieve by FY30. And the remaining 40 around 40 million tons to reach the 400 million tons capacity is would also not be a problem, given the strong prospects of major port terminals privatization. So, as we were talking about the group captive cargo, I'd like to give an example here. So, JSW Infrastructure, it targets to commission its Keni port in Karnataka in FY29, as you can see in the second phase of its planned growth. So this Kenny port is supported by the volume from its Vijayanagar JSW Steel's Vijayanagar steel plant. So currently JSW's Vijayanagar plant is serviced by Krishnapatnam port, which is owned by Adani, and various other ports. There are a couple of ports in Mangalore which are also handling JSW's Vijayanagar steel capacity, but they have a steep royalty rate. So after the current expansion plans which it has in its Vijayanagar plant of around 2 million tons, there's another scope of 5 million tons capacity expansion. So this expansion should drive the demand for coal imports and the exports of steel, which in turn will provide additional cargo volumes for Kenny. So we look at its logistics sector roadmap. So JSW infrastructure constitute around 20 to 25% of JSW Steel's logistic cost in FY23 and FY24 from the port operations alone. With the acquisition of Navkar in FY25, as we talked before, and commissioning of the slurry pipeline in Odisha by end of FY27, JSW can address the largest share of the group potential. These inland rail and slurry pipeline revenues can be topped up by third-party cargo, along with the base cargo support from the group. So yeah, so this is a steel expansion. JSW Steel has. So if we see on the top, every 1 million tons of steel capacity expansion will lead 3 million tons of raw materials. And if we count the, let's say, it's being transported from JSW Infrastructure's ports near the coal mining capacity to JSW's ports near the steel mill capacity, the volumes are counted two times. So the incremental cargo which can be expected by FY28 is around 52 million tons, and by FY30 it is around 73 million tons from JSW Steel's expansion alone to JSW infrastructure. So and JSW infrastructure, as we talked about, is also a play on coastal coal. So JSW's Paradip port, which is located in Odisha, is well placed to benefit from Coal India's movement of thermal coal from its Mahanadi coal fields to thermal power plants along the east coast. So Coal India also recently thrust on rail sea rail movement as an effort to expand the evacuation capacity of coal, which has so far been hampered by the shortage of rail rakes. Now, these coastal coal movements are mainly third party, non JSW group in nature, and they will also significantly aid in increasing cargo diversity beyond related parties. So, yeah. Again, the benefit of coastal coal movement will also be from its value being recognized twice, once at Paradip Terminal, the origin, and once at maybe Ennore or Thoothukudi, which is the destination terminal. So this will lead to higher reported volume and revenue for the port. So the risks associated with the JSW infrastructure, the 25% of the announced capacity is linked to the expansion of group companies, JSW Steel and JSW Cement as well. So if there usually historically there has been times where capacity expansion has been delayed. So any delay in this uh, planned capacity expansion will be a risk for the company as they would have to solicit third party cargoes to ramp up their utilization. And also, they have a high reliance on coal and iron ore cargo. So, if there are sudden shocks in commodity prices, because both of them are very cyclical industries, there can be a high impact on JSW's capacity utilization. And so that is another risk. And the other broader risks like macroeconomic risk, over leveraging risk, and aggressive pricing in logistics, which we discussed for Adani infrastructure, also applies here. So currently, JSW infrastructure is not that over leveraged. It's around 0.5x debt equity, and the management is confident and comfortable of taking it up to 2.5x. So we can expect significant investments in the logistics and port segment of JSW infrastructure in the future, funded through debt. So yeah, and also international expansion. Like Adani, they are focused on international expansion. Now they have a liquid terminal in Fujairah, and they have bid for a terminal in Oman as well. So these international expansions would pose geopolitical risks and also currency risks. So yeah, these are the risks associated with the JSW infrastructure per se. That would be all. Thank you for joining today's webinar on a Saturday afternoon. I hope I provided some sort of value today. Thank you and have a nice day.